Now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal. The full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is Monday as we head into earnings week. That's right. This week, we're going to start getting the big earnings announcements. And of course, this really is the kickoff of earnings with the major banks this week, JP Morgan, Wells Fargo, etc. Then over the next 2 weeks, we really get into the heart of earnings season by Friday, not the following Friday next week, but the Friday after that. We'll have about 80% of all S&P 500 companies will have reported. So over the next really 3 weeks, it's going to be very, very busy in terms of earnings season. Lots of things driving the markets. Expectations right now are very low relative to what likely will come in. So we're probably going to have a fairly high beat rate in earnings this quarter because a lot of the analyst estimates have really come down this quarter because of the whole initial concern about tariffs. And then, of course, over the weekend, it was interesting. Over the weekend, Trump slaps a 30% tariff on the EU and Mexico. Last night, I checked futures, and they were down about 200 points on the Dow, right? So kind of what you would expect. This kind of, we're back to this whole big tariff debate thing. Rapidly coming up here is August the 1st, which is the official deadline of those tariffs, which means that potentially tariffs all go up on these countries if deals aren't done yet. So, but you would expect the markets to be down fairly sharply on that kind of surprise news last night. But this morning, futures have cut that about in half. So, we were down about 200 points on the Dow last night. We're down about 100 points this morning, about 19 points on the S&P. Last night, we were down about 40. So most of those losses, again, this has been one of the things about the market as of late, is that the market's really kind of seeing through tariffs and going, okay, yeah, I get tariffs, but we're starting to see that companies are kind of eating these tariffs, which are bringing down the margins, and there's been some margin reductions, expectations, and it's not really getting passed through a lot to consumers yet. Now, having said that, this week we're going to get CPI. Let me warn you about CPI real quick for this week. We've had 4 straight months in a row where CPI has come in below expectations. There is a reasonable probability that we're going to see a hotter than expected inflation print, not because of anything going on because of tariffs or whatever else. It's because expectations have now been ratcheted down for a fairly weak inflationary print. So it's very likely we're going to have an inflation beat. Expectations are probably going to be around 0.1. We come in at 0.2. It's not a big thing, but everybody's going to get excited. It's like, oh, inflation is hotter. See, tariffs are coming back. No, it's just because expectations have really gotten ratcheted down because analysts have been wrong for 4 months in a row. That's just the way it works out. So, there's a lot going on this week. CPI, PPI, earnings, going to be a very busy week for markets. Lots of stuff kind of moving markets around. I suggest that you don't get too overly worked up about what's happening in the short term right now and keep focused on really where markets are and kind of what's going on next. In fact, we're going to talk about that some more this morning, talking about absolute versus relative returns and really kind of what's more important for you to focus on. But an interesting study out this morning, I think most people agree with. Study came out this morning talking about Mondays are the most stressful day of the week. Even for retired people. Yeah, like when I was on vacation, about 2 days into vacation, I really didn't know what day it was anymore, right? Because, when I'm here, I know Monday I've got to do this. Tuesday I've got 2 Dads on Money with John Penn. I've got Danny on Wednesday. I know what's going on every day of the week, right? But when you're on vacation, and when you're retired, right? What are you stressing out for about Mondays? But this study actually revealed that on Mondays, they tested people's hair. They couldn't test Brent. But they test people's hair and for cortisol. Cortisol is your stress hormone. Yes. And so when you have elevated levels of cortisol, that's why you gain weight around the middle. You don't sleep well, all those type of things. That's because elevated cortisol. So they tested their hair. They find out that on Monday, even retired people, Monday mornings had 23% more cortisol because they were stressed out over Mondays.
Really?
Yeah. So if you're feeling out stressed because today's a Monday, don't feel like you're alone.
Join the club.
Exactly. And if you gained weight, there you go.
There you have it.
But I don't know why Monday, if you're retired, why are Mondays stressful?
It's permanent limbo.
Right?
Yeah, you have no direction.
Gotcha.
No path forward.
I actually look forward to Mondays because I enjoy doing the show. I
Yeah.
enjoy coming down here. I mean, a couple of days sitting around the house on weekends, I kind of get bored, right?
I'm ready.
Yeah, I'm ready to come back. So, yeah.
My wife's ready for me to come back, too.
I bet she is. Speaking of wives, I have a story about mine from over the weekend, so we'll get into that one.
Oh, boy.
Yeah, nothing good coming out of this event, let me tell you. Anyway, all right, well, here's what you need to know before the bell this morning. So, like I said, earnings week coming up this week. It's going to be a lot of stuff moving markets. Technically, the markets are doing just fine. There's nothing really kind of wrong. If you haven't read this weekend's Bull Bear report, it's on the website. It's our weekly newsletter. You can also get it on X if you haven't followed me on Substack yet, at Lance Roberts. It's really easy. Go to Substack. Follow me at Lance Roberts, and I post everything there. It's a really kind of easy platform for reading, getting stuff that emails you a notification when I post, so it always keeps you up to date. But you also get it on our website, realinvestmentadvice.com. But anyway, this weekend's newsletter, I laid out a 3-month view of kind of what the markets are going to be doing on a probability basis. So about 50% probability this kind of bull market trend is going to continue. There's not a lot to really bring this market down. But having said that, again, there's another 50% that's either just a choppy sideways market, which is about 15%, 35%. We actually get a correction at some point in, potentially August, September. But if you pay attention to what's going on with the markets right now, we've got kind of a very similar setup going on. If we go back to May, markets got very, very overbought. And, we kind of saw this very kind of overbought condition, and it led to a bit of a correction back to the 200-day moving average. And that was a really good setup for adding money to portfolios. We had this big correction, got above all these moving averages, corrected back to that important level of support. Market worked off some of its overbought condition, but not a lot, right? We just kind of chopped around a bit, and then markets kind of took off again. Here we are. But again, we're starting to see this kind of same topping pattern and relative strength. Now, I would suspect that at some point you're going to get this kind of at least medium-term correction of some sort. Could be later this month, could be next month, but we're seeing this kind of topping and relative strength, close to triggering a bit of a momentum sell signal as well. So again, just a pullback to the 200-day moving average, which would pull you back to around 6,000-ish right now in the S&P. That's about a 5% correction, so it's not nothing, as they say, right? So again, you want to be a little bit cautious here. Markets are pretty stretched going into earnings. Now, expectations are really, really high right now for earnings season. So, just be a little cautious here. It really makes a lot of sense to come in and just do a little bit of rebalancing your portfolio. Just, take some gains out of your winners. If you've got stuff that's really just not performing, this is a really good opportunity to let it go, because if it hasn't performed in this market as of late, it's not going to perform well when the market goes down. So just, kind of think about your portfolio. And we talked a bit over the weekend about, beta and managing portfolio risk, et cetera. So again, when you just look at your portfolio, if your portfolio is moving up or down more than the market on a daily basis, your beta relative to the market is higher, which means that if you get a 5% correction in the market, your portfolio is going to be down more than 5%. And if you're okay with that, that's fine. Nothing wrong with having higher beta in your portfolio as long as you're aware of it. And again, if we have a 5% correction, which is becoming a little bit more of a realistic probability at this point, it's just because markets are getting very stretched, they're getting extended from their 200-day moving averages, et cetera. Just a normal pullback to support will be 4 to 5%. If you're okay with that in your portfolio, that's fine. But if not, you may want to think about taking a little bit of action here, just doing a little bit of cleanup work around the edges. Again, nothing dramatic. It doesn't mean sell everything. But there's a lot of positions that have really, really gotten extended here as of late. NVIDIA is a good example of that, really extended. And so if you get a correction, that stock has a higher beta than the market. It's going to go down more than the market itself. So just be aware of that risk and kind of take a look at your portfolio today and think about what you need to do going into earnings season here over the next 2 weeks. All right, that's what you need to know before the bell this morning. We'll come back. We'll talk about absolute versus relative returns. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Got questions about retirement? Let's talk about it over coffee. Our next Candid Coffee event isn't another sales pitch. It's your chance to learn how to turn savings into strategy and risk into confidence. Richard Rosso and Jonathan McCarty share the RIA Retirement Blueprint Saturday, July 19th, in a special Candid Coffee edition designed to help you structure your savings, level your risk, and craft a secure future. If you fail to plan, you plan to fail. Register now for the RIA Retirement Blueprint, Saturday, July 19th at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, as you know, I'm constantly on a diet of some sort, working out, taking care of myself, doing those type of things. And, it's a challenge, right? I enjoy going out, having a nice dinner, doing whatever. So, like this weekend, I was supposed to go to Chuy's to have Mexican food this weekend, right? My daughter was supposed to meet me there, right? So I was all excited about this because I've been really saving up my calories all week long. This has nothing to do with my wife yet. That story's coming. So my daughter, who's 18, she's super book smart, right? So scholarship to Baylor, whip smart in terms of academia. Common sense, not so much, right? So she's out in Katy, right, with her boyfriend, and she said, we told her earlier this week, hey, we'll meet you for dinner. We live inside of Houston city limits, and we said we'll meet you for dinner at Chuy's, and so I'm all excited. So my wife and I get dressed up. We go to Chuy's. My daughter's not there, and I'm like, "Where are you?" And she goes, "We're already seated." And I go, "No, you're not." And she's at the one out in Katy.
Oh yeah.
So I was like, "Well, I'm not driving out there. So have a good dinner. I'll see you later." So I did not get my Mexican food this weekend. So I'm a little upset about that. Anyway, my wife on Sunday goes to a sourdough class.
Oh.
Yeah. Oh.
Is this part of the bakery thing?
Well, that probably will eventually be, but no. So her father wanted her to go with him. She was like, "I don't want to go. It's Sunday. I don't want to go to this thing." And so her dad's like, "Hey, come on, go with me." He likes to do stuff like that. He's retired, so Mondays don't stress him out. Apparently,
there you go. Yeah.
And so she goes to the sourdough class. So anyway, she comes home. She's all excited. She's just so excited. She goes, "I had so much fun. This is great." And so she made this blueberry lemon sourdough bread. Right, which is it's wicked good.
Yeah.
And then the next thing I know, there's like $250 worth of stuff ordered on Amazon that's coming from containers to knives to mats to everything else. So she now has a very long list of sourdough products that she'll be making because apparently, as with cottage cheese, which I had no idea that you could make everything out of cottage cheese, right?
Yeah.
And it gives you higher protein. It's healthy. You can make everything out of sourdough, from
Absolutely.
pizzas to bread to everything else.
Yeah.
So
Nothing wrong with it.
except it's not great for my diet.
Well, there's that.
So, and then of course, because she makes it, I have to eat it because I don't want to hurt her feelings.
Yeah.
Yeah.
She's been bitten by the bug.
Yeah. Yeah. Just I'm waiting for the starters to be lined up all in the refrigerator. So if you have a spouse that is into making sourdough, please commiserate with me, because I have a feeling we're bringing lots of stuff to the office now.
Yes.
Anyway, lots of stuff to talk about this morning. So I want to talk a little bit about absolute versus relative returns, because this is kind of, we're getting into that stage of the market where the understanding of risk taking is kind of getting skewed in terms of, what that means. And it was interesting because as I'm talking about this, Brent posted a note on my notes page this morning talking about 50 contronyms. If you don't know what a contronym is, that's a word that has opposite meanings. Right, it has two meanings that are diametrically opposed. So, for instance, rent. It means to, rent as an example means to pay for something or to tear something apart, right? Flog, which I thought was one of the interesting ones. It means to promote aggressively or to beat severely. So, I like that. I always like that word. But the term risk often gets misunderstood in terms of it means how much money you'll make. It also means how much money you'll lose. And when we get into more bullishly exuberant markets, we get this idea that risk only means the more risk I have, the more money I make. But we forget about the other side of that, which is when markets go down, that amount of risk you take has very severe consequences to it. Now, there's nothing wrong with that. As long as you just, there's nothing wrong with risk as long as you understand what you're getting yourself into and kind of what you're signing yourself up for, so to speak. And this is where absolute versus relative returns comes into play. And relative returns are simply just kind of a real simplistic definition. If the S&P goes up 1%, your portfolio goes up 1%. You're just trying to track the S&P 500 index. That's your goal. So that's relative. So how was my performance today relative to the index? So I look at my portfolio. My portfolio is up 1%. The market's up 1.5%. On a relative basis, I underperformed the S&P 500, right? So that's relative. Absolute is I don't care what the index does. My goal is to generate X amount of money every month, every quarter, every year. That's absolute. What was my return on an absolute basis? That's all I care about. And there's consequences for both of those. Again, on a relative basis, I'm fine as long as markets are going up. I'm not so fine if markets are going down. The goal of absolute returns are, I don't care what the market's doing. My goal is to make money of this amount on an absolute basis, regardless of what the index is doing. If the market's down, 5%, I'm still trying to make money. That's my goal. If the market's up, I don't care how much the market's up. I just want to be making this amount of money. That's my goal on an absolute basis. So, so understanding this helps you start to define what your goals actually are with your portfolio. And we all have this kind of idea in our head. And again, I hear people tell me this all the time. It's like, if I could just get 4% a year, I'm completely fine. I don't care what the market does. Well, that's fine until the market goes up 20%, and then you're, crying in your oatmeal why you didn't make 20% last year, right? Because your portfolio is not allocated for that. So as long as you understand what you're kind of signing up for, so to speak, you can start to look at your portfolio in a little bit of a different manner. So today's article on the website, so again, if you either follow me on Substack at Lance Roberts, I posted on our X account this morning at Lance Roberts on X. It's also on our website, realinvestmentadvice.com, so lots of places to go get it. But anyways, it's talking about absolute returns versus relative returns and what's better for you as an investor. And this is really a personal thing. And neither one of them's wrong, by the way. If you want to be a relative investor, it's completely fine. So go buy an S&P index fund, sit back, enjoy yourself, have no stress on Monday mornings, keep more of your hair. It's all great, right? You're going to go up and down with the markets over time. And it's given that markets rise about 80% of the time, you're probably going to be okay. It's those rare occasions that markets don't go up that become problematic. So when you eventually get into your next kind of financial crisis type event or next .com crash period. And that's going to occur. I was talking about that just recently with Adam Taggart, which is saying is like, there's all these people out there right now talking about their market's going to crash. We're going to have a 50% correction. And a lot of these guys have been saying that for years now, right? The markets are going to crash by 50% and, it's going to happen. Well, yeah, it's going to have, absolutely, we're going to have at some point in the future a 50% correction. But here's the thing about predictions. So when you hear people saying things like the housing market's going to crash or the markets are going to crash or whatever it is, or vice versa, right? The market's going to go to 10,000, whatever. There needs to be three things to quantify that statement to make it of any use whatsoever. Will the market go to 10,000? Yes, absolutely. Someday. The S&P 500 will be 10,000 instead of 6,000. Is the market going to crash 50%? Absolutely. Someday. That's going to happen. But to make either one of those predictions valid or useful to you as an investor, it has to contain three elements. The market's going to crash 50%. When? Now, it doesn't have to be the exact day. It doesn't have to be August the 14th at 7:30 p.m., when Virgo was in line with Mars or whatever. But it does need to be the market's going to crash by 50% within the next 12 months. Why? Because of this fact or this reason. Okay, what's the course of action? The course of action is to sell here and to buy here. Now, if I'm not providing those three facts in my outlook, the outlook is useless because it doesn't tell me when I need to take action. It doesn't tell me what actions that I need to take. And look, and just telling you to sell is fine, but I also have to tell you when to buy back in. And this is a problem with a lot of these kind of doom and gloom, forecasts, which is the markets are going to crash by 50%. Okay, fine. I can step out of the way of that. But when do I buy back in? Well, the problem is they never tell you that. They just tell you the markets are going to crash and you need to own, whatever. And they never tell you that at some point that's all going to reverse. So when you're listening to these more dire forecasts, take it into kind of an assessment of saying, okay, great, you haven't told me anything. And if you just keep telling me every year the market's going to crash 50%, and there's guys who have been saying this for like 10 years now. Someday it'll happen, right? But how much money do you lose by not participating in the markets during that time frame? And this is where absolute returns absolutely come into case. And we'll talk about that after the break. Don't go away.
Blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Got questions about retirement? Let's talk about it over coffee. Our next Candid Coffee event isn't another sales pitch. It's your chance to learn how to turn savings into strategy and risk into confidence. Richard Rosso and Jonathan McCarty share the RIA Retirement Blueprint Saturday, July 19th, in a special Candid Coffee edition designed to help you structure your savings, level your risk, and craft a secure future. If you fail to plan, you plan to fail. Register now for the RIA Retirement Blueprint, Saturday, July 19th at realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Last night I got home and my wife was all excited. I went to ChatGPT and I've laid out a whole business plan for a coffee shop. I'm like, oh God.
The Real Investment Show podcast.
Well, a long time she's wanted to have her own bakery and I've been slowly encouraging her not to.
Same show, your schedule.
So I may be in the coffee shop business here soon, so I may need your help to support my wife.
The Real Investment Coffee Shop.
Exactly.
I like it. It's got a nice
like
ring
the
to
sound
it.
of that.
Exactly.
We'll have a couple soapboxes in the corner. We can stand up and we can put them to sleep with economics. Then they need more coffee. And then we'll go through, we'll sell so
Brilliant.
much.
At realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Sounds like Halloween music. Too early for Halloween. I'm not ready for that yet.
Getting ready for your next story.
I don't have a spooky one yet. Guess that's coming. So talk a little bit about absolute versus relative returns. And so just talking a little bit of a segment, in the last segment, just wrapping that up, saying, just be careful of these really kind of, pessimistic outlooks where the markets are going to crash. Because that's where we make, again, you can go back to our website and, search for psychology or behavior, and we just have tons of articles about, emotional biases, how to invest, how to avoid those psychological pitfalls when investing. And it's all about our behaviors and how we emotionally respond to things. And as human beings, we tend to gravitate towards negative biases. That's just who we are naturally. And so when people talk about a 50% market correction, here's a case in point, right? So I did an interview, our weekly podcast with Adam Taggart with Thoughtful Money, and I'm talking about, the markets are in bullish commentary, bullish mood. Asset prices are rising. Everybody's super speculative, and I made this one passing comment. So the whole show is pretty much very bullish on markets right now because markets are bullish. I made this one passing comment that it does remind me a little, the kind of the exuberance and the outlook reminds me a little bit of 1999 from the standpoint of just everybody's so excited about AI. We were very excited about the internet back then. And so the title of the video for this week is Echoes of 1999, right? Right. And that's only just to get you to click. That's clickbait for the interview. right? It's just to get you to click it because we have this natural bias to be negative. And I get it, right? It's just marketing. But if we focus on, and this is our focus in our shop, we're not worried about beating the S&P. That's not our goal. Our goal is to create absolute returns over time. And the reason for that is, and the model that is set up for that is to capture 80% of the upside of the market and about 20% of the downside. And if we do that over time, you'll reach your goals. And so here's a chart to explain this. So the blue bars in this chart, if you're driving this morning on your way to work, don't worry about this. It's on our YouTube channel. So go back and watch this segment. But the blue bars are the S&P returns. So if you just match the blue bars, you've got relative rates of returns. And this is just kind of looking back historically and using kind of market returns, et cetera. The orange lines are absolute returns, and that is capturing 80% of the upside and about 20% of the downside, give or take. Right. And so the goal of this is to navigate the risk of the market. So look, and every year I'm going to underperform on the upside, but the goal is to outperform in down years. And it doesn't mean that I don't lose money. I just don't lose as much as the market. And that's critical to the process of building wealth over time, because if I map this out, if I take this and I plot this out on an investment basis, what we find out is that over time, an absolute return portfolio will outperform a relative index over time, right? Not necessarily every year, not necessarily in the heat of the moment, certainly not right now. That's a good example of this. But over time, absolute returns will outperform because you're not giving up as much money on the downside. So again, when markets were down in March and April, we're down 19, 20%. In April, our portfolios were down about 5%. And so our portfolios reached new all-time highs before the market did. And that's in that wealth building process, right? And so that helps again, what we want to try to do, and this is one of the big fallacies of markets. I heard this girl on TikTok over the weekend, and she's got like 2 million followers, right? And she's promoting all this financial advice for millennials. Like, if you just take $25 a week and put that into an account, in 10 years, you'll never have to invest another penny, because that you'll have invested like $60,000, and by the time you're retired, it'll be worth $1.8 million. And I'm like, this sounds great. Perfect. All right. What's your assumptions? Assumptions are a 10% compounded rate of return. Markets don't compound at 10%. Because in a year, and here's some math for you. You can do this on your own at home. Let's just take 5 years of returns. That's all. Just 5 years. And if we have 10% the first year, our annual rate of return is 10%. If we have 10% the next year, our annual rate of return is 10% on average, right? This isn't hard math. In the third year, I make 10%. So I'm now up 30%. This sounds great. So I've taken $100 and I've turned it into $130. Well, if I lose 10% in the fourth year, I cut that rate of return in half. It now takes me 30% roughly to get back on track to earning 10% a year. A loss in a single year destroys the compounding impact of portfolios. And here's the reason why. If I make 10% the first year, 10% the second year, 10% the third year, and I lose 10% in the third year or the fourth year, I was supposed to make 10% that year. So I didn't get the 10% I was supposed to get, and I lost 10% on top of it. That's a 20% hit off my return goal. So losses in any given year destroy the impact of compounding. This is the one thing that all these financial wizards don't tell you, that are promoting this idea of, just invest in the market. It generates 10% on average. Average returns and compound returns are very different things. And this is one of the big marketing fallacies of Wall Street, and why people don't make money over time is because they buy into this analogy that, the market's compounded 10% a year. They don't. The only thing that compounds at 10% a year is anything that doesn't lose money, bonds, right? I buy a bond, it gives me 10% a year. I take that 10%, I buy a new bond with it every single year. I'm compounding now at that rate of return every year. So if I'm buying 4% treasuries, I'm compounding at 4% a year, but I can never lose money because that bond always matures at face value. That will compound. Markets do not compound returns because of the impact of losses. You can have an average rate of return, but you can't compound it. And those are very different things. So just be careful with all this. But again, going back to our story here, even though I underperform in an absolute return model in every up year of the market, I can beat the market long term, which isn't that our goal, right? By not losing as much when markets go down because of the importance of the compounding effect. So just, again, you have to step back from all of this and kind of look at how the math actually works. And look, all these headline narratives and things are fantastic. They're wonderful. 90% of it's garbage because they're trying to sell you a fund or an ETF or whatever it is. It's like, oh, just buy this and this is going to happen over time. It generally doesn't. And particularly when you're in a much more speculative environment like we're in right now, that risk compounds pretty aggressively. And again, we're not in an environment where, we're going to have this massive crash. We don't really have the underpinnings for that right now. We don't have some type of phenomenal stretch in credit risk or anything like that at the moment. But the thing that gets the markets are the things that we don't know. We were kind of aware of subprime back in 2007. We knew there was an issue there, but nobody knew that we would force Lehman into bankruptcy. Nobody ever saw that coming, right? It's those types of anomalous exogenous events that create major market downturns. And again, the problem is you never know when one of those things is coming, right? Enron, we talk about the dot-com crash like, oh, it was just because the internet didn't play out the way everybody. That's not true. The internet played out just actually in spades relative to what people thought it was going to be. Everybody was thinking, oh, it's a fad. Nobody who's going to use the internet is just for posting bulletin boards and stuff. Nobody knew what the internet was actually going to become. What caught the dot-com crash, or what created it, was Enron. Because when Enron failed, everybody started looking at balance sheets all of a sudden and going, oh, wait a second. You mean all these assumptions are not true? And there's all this kind of funny accounting going on I wasn't aware of. And then all of a sudden we had Global Crossing, Lucent, WorldCom. All these people just started falling out of bed because the scam was revealed. But that didn't have anything to do with the internet. But what we found was we found all the cockroaches in the kitchen that was caused by the speculation drive in the markets. All these Wall Street analysts, I can't remember his name. He now runs Business Insider, or did. Henry Blodgett was a Wall Street analyst, and he got barred from Wall Street because he was always just saying, hey, these stocks are doing great, and here's my forecast, and they were just completely facetious. So we got banned from Wall Street and started Business Insider, which is completely facetious. So read all their headlines. It's like, market's going to crash. But, you got to be careful with this stuff. Anyway, we'll come back and get ready to wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Got questions about retirement? Let's talk about it over coffee. Our next Candid Coffee event isn't another sales pitch. It's your chance to learn how to turn savings into strategy and risk into confidence. Richard Rosso and Jonathan McCarty share the RIA Retirement Blueprint Saturday, July 19th, in a special Candid Coffee edition designed to help you structure your savings, level your risk, and craft a secure future. If you fail to plan, you plan to fail. Register now for the RIA Retirement Blueprint, Saturday, July 19th at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show. So just talk a little bit about absolute versus relative returns. And again, that article is on the website right now, realinvestmentadvice.com. I posted on X this morning. It's on our Substack account. If you haven't followed us there, be sure and do that. Also, be sure and like and subscribe to the channel. Again, as always, certainly helps us out. And I appreciate all your help and support. And it helps us get, kind of keeps us going with Google and helps us kind of reach more and more people, which is our goal. And so certainly appreciate all of your help with that. So just like and subscribe and just click the button. Doesn't cost you anything. And that'll become much more important here. We have a big announcement coming up at the end of this month. So being liking and subscribing to this YouTube channel is going to be very important as we get closer to the end of the month and we make our announcement. So some changes are coming and some people will like it. Some people won't like it, is always the case, but some changes are coming. Let me show you this chart real quick, this is a chart, it was put out by Morgan Stanley this morning, and is a chart of the S&P to this year versus 2018. And I've written about the 2018 paradigm before when I was talking about Trumpflation. So back in November, everybody was running around yelling that Trump, tariffs were going to cause this massive inflation in the market. It was going to crash the market. And I was like, no, actually, that's not the case. If you go back and look at 2018, 2019, which was the last time that we had tariffs going on in a trade war, you had some initial angst in the markets, but then markets recovered after that and inflation fell. And, all these terrible narratives never worked out to be the case in 2018, 2019, when we were doing exactly the same thing. Now, that was in November. The tariffs were a bit more aggressive this time than what we had last time and more broad. So again, that 20% sell-off that we had in March and April was a realization that these tariffs were a lot more restrictive than what we saw in 2018. However, markets have adapted to that and then now rallied back, much like they did in 2018. In 2018, we had that initial angst over the trade war with China, and then markets got okay with it, started to understand, looked through it, said, okay, how's this going to impact earnings? And then they started running markets back up on that. The end part of that chart is interesting, which has nothing to do with tariffs. That sell-off at the end of the chart in November and December was because the Fed was hiking rates going into September. In fact, at the September Federal Reserve meeting, Jerome Powell stated that they were nowhere near the neutral. So Fed's hiking rates, and he says we're nowhere near the neutral rate, which suggested that the Fed was going to continue to hike rates for a while longer because they wanted to get to the neutral rate. This was, of course, where Trump came to the fore at that point, started chastising, Powell, threatening to fire him, trying to figure out a way to get rid of him. He needs to be cutting rate. He's too late, blah, blah, blah. And the market started selling off because of interest rate concerns. And so when the markets were down about 20% in December, Jerome Powell backed up and said, even though they hadn't done anything with interest rates, we're very close to the neutral rate now. So we don't need to hike rates anymore. And in fact, by June of next year, they're starting to cut rates. The reason I bring this up is that if you're looking for a risk to the markets, there is one kind of brewing, and that's this whole fight right now between Powell and President Trump. And President Trump wants to get somebody in that seat that will cut rates more aggressively than Powell, which is sitting back right now saying, I don't need to cut rates. We're being data dependent, blah, blah, blah. But, the rest of the world, in fact, I've got a chart on this in an article coming up here at the end of the week. But I've got a chart on this, which is showing that, every other central bank in the world is cutting. UK, Australia, Eurozone, Japan, they're all cutting rates. And we're not. Now, that doesn't mean anything. It just means we're not cutting rates yet. That's all that means. But this whole spat between Powell and Trump is now heating up. And in fact, over the weekend, there was an article that was published expecting Powell to resign over this whole renovation of the Federal Reserve building. And so there's these two buildings. There's the Reagan Center and then the Eccles building, which is they're in right now. And they're renovating the Reagan Center for the new offices, and they're going to move the Fed. And this renovation is a couple of $1 billion, and it's about $750 million over budget right now. And so there was a lot of accusations that, the Fed was mishandling this renovation project, and that could potentially be grounds for termination for Jerome Powell. Now, look, a lot of this is a stretch. Right. And again, this is a lot of media reporting and stuff, so you just take it with a grain of salt. But this was the angst over the weekend. And my issue is, or my point is that tariffs are one thing. There's a lot of focus on tariffs right now, but the markets are looking through tariffs and going, okay, tariffs aren't going to be the major impact that everybody thought it was going to be. And this is playing out a lot like we saw in 2018. If you're looking for a potential event, right, that could undermine the markets, this kind of spat between Jerome Powell and Trump is very reminiscent of what we saw in 2018. Now, at the end of the day, back in 2018, Powell relented. They started cutting rates in June. Everybody was happy. It was kumbaya. He finished out his term and then picked up his next term with Biden. Jerome Powell's term is up next year. So we'll see what happens. But again, this, if they try to force Powell out of the seat or they force him to resign, and there was an article over the weekend also talking about that Powell may resign as early as today. I don't think that's going to happen, but that was the media headline. That could potentially kind of undermine the markets a bit, just from the standpoint that while the administration wants Powell to cut rates, the market really wants an independent Fed. They really don't want one that is politically influenced for whatever nature it is. And look, there's arguments right now. I'm not arguing with anybody on this, so don't think I'm picking a side. There are arguments right now that Powell is being politically influenced. The reason he's not cutting rates is because he doesn't like Trump, so he's not going to cut rates to help Trump, right? That's one of the arguments. His argument, Jerome Powell's argument, is they're being data dependent and they're just focusing on the data, and the data doesn't warrant cutting rates. And I don't really agree with that point. I mean, if we take a look at employment, yeah, it's still positive, but it's weakening pretty markedly. If we take a look at a lot of the underlying employment indicators, certainly suggest that there is a weakening in employment, certainly worth being concerned over. High interest rates are impacting consumers. We're seeing default rates rise, those type of things. So there's ample evidence that the current interest rate policy is probably too high in the current economic environment. And if you don't start cutting rates soon, you may run the risk of tripping up the markets at some point in the very near future and creating a bigger problem where you have to now come in and slash rates much more aggressively to try to provide some underpinning for the markets and the economy. I think there's some data that supports that. But again, what Wall Street wants is at least the overall appearance that the Fed is independent. So again, I think if you're looking for a risk to be aware of, I think that's potentially a risk to be at least paying attention to, is that if this drama picks up and Trump or the administration is successful in forcing a resignation, that could undermine the market a bit, at least on a short-term basis. So, and again, what we're talking about is that, look, markets are extended, as we were talking about earlier in the first segment of the show today, that, we're potentially due for a 3 to 5% correction. Something like that could certainly spark that kind of a sell-off. And again, it'll be short-lived. It'll, very quickly, there'll be a new appointment for whoever's to replace Powell. They'll come in, they'll cut rates, and then markets will start to adapt towards, that chairman and that Fed, right? And so, okay, well, now what are they going to do? They're going to cut rates more, and then markets will recover pretty quickly. But again, as we're talking about risk and risk controls this morning, we have to at least be looking forward to things that could undermine the confidence of the markets. And remember, markets are all of, we talk about, this person's a con man, or this person's running a con. Con is short for confidence. Okay. It's a confidence game. If I'm running a con or a scam on Brent, what I'm trying to do is gain his confidence so he'll give me his money, right? So it's called a confidence game. The markets are a confidence game. It's all based on confidence. And as long as investors are confident in what they're hearing from the markets and from the analysts and from the underlying corporations, et cetera, they're willing to keep throwing money at the markets, right? Who winds up with the money at the end of the day is Wall Street. So even when the thing fails. So again, the markets are a confidence game at the end of the day. And we need and so what we want to pay attention to is things that could undermine that confidence. This whole thing with Powell and Trump may be a big nothing, could be a huge nothing burger. But I think there's enough risk to at least be paying attention to headlines and kind of what happens over the next couple of weeks, because I think that's about to come to a head here pretty shortly. We'll see what happens. All right. That wraps up the show for today. Be back tomorrow with John Penn, talk about Two Dads on Money. Be sure and get by the website, realinvestmentadvice.com. Like and subscribe to this YouTube channel. Certainly appreciate it very much. Just hit that little heart button. Like the channel today. That certainly helps us with our algorithms. And follow me on Substack, at Lance Roberts, right? So post everything there. You get email notifications. Super simple. Very easy to get stuff. It's all on the website, realinvestmentadvice.com. Have a great day. See you back here tomorrow.